Okay, welcome back to the live stream of the Pension Fund panel. We move now to item 8, Pension Fund Administration Update. Jenny.
Yeah, the good news is the figures are improving. We're back up to 95% on the SLA. There are still some delays. I'll have to admit to that, mainly on retirements, and the death cases are improving, and there were some reasons for the poor figures in the last report. The system, there seemed to be some flaws in the system and the way it had been set up, but the LPPA have investigated this, and on the death cases particularly, when I was discussing things with the death team, there was no way they could have met their SLAs. They were set up to fail, even though they were meeting the targets. So things are improving. They have just moved into taking on the rest of their clients and moving them to UPM, but this again should be completed by the end of January. So yeah, there's going to be a shutdown next week for 3 days, which is unfortunate but necessary. But yeah, if there's any other questions.
Thank you very much. Questions to Jenny? No? Thank you very much. Is that report noted? Thank you very much. Thank you, Jenny.
Thanks.
Moving on to item 9, the Pension Fund Performance Monitoring Update for the quarter ended 30th of September 2022. Bridget?
Okay, I'll just highlight some of the items for approval and the key items for noting. And then William will talk a little bit about some of the market volatility that we've seen of recent, and together we'll address any questions that you might have. So the key thing is for approval is that we'd like to approve topping up another one of our private debt managers, just to keep the private debt allocation constant, because that's something where the money constantly is coming back to you, and then you just have to keep topping up. And William can talk about that more if you have any questions. Just to note that we are going to have an in-person AGM for the first time since COVID, and we're trying to get a date either towards the end of February or early March, and I understand that the Victoria Hall will still be available then. Otherwise, there's no other items to highlight unless you've got any questions, but we can move over to William to update on recent market volatility and how that might have impacted pension funds, mostly in the corporate sector, but talk a little bit more about that.
Thank you, Bridget.
Thank you. I was conscious that the Q3 had been a rather exciting time in markets, and not in a good way. So I suggested to Bridget that I give a brief update as to what has happened and some of the implications for the fund. So obviously the main thing was inflation, which continued to rise, but also perhaps more worryingly become entrenched in higher wage settlements, in expectations of future inflation. As you know, that led central banks and the Bank of England in particular to start raising rates to combat inflation. Higher rates mean a weaker growth outlook, and the outlook for next year on growth has been deteriorating for the last 6 months or so. 2022 outturn, though, should still be pretty strong. A number of developed economies, including, I'm afraid, the US, in the UK, are likely already in recession. So higher interest rates and higher expected interest rates mean that government bond yields go up. And when government bond yields go up, generally asset prices go down. And that is precisely what we saw in Q3. Almost every major asset class fell in Q3. Have rebounded a bit after the end of the quarter, but quarter three was a pretty dreadful period for asset returns. The fund was protected in two ways, because you'll have seen in the papers that the fund's overall return in quarter three wasn't actually that bad at all. It was negative, but it wasn't dreadful. Protected in two ways: one, diversification, and secondly, you own a fair amount of assets in dollars, and with the dollar strengthening and sterling weakening, that actually protected the returns that you receive in sterling. Higher government bond yields has a silver lining on the liability side. So when yields rise, and if that rise is sustained over time, that will reduce the value of the liabilities, because the rate at which the future benefit payments that have to be made are discounted back to the present day is higher. So yes, asset values have fallen, but if we were to redo the valuation as at the end of September, we'd probably find that liability values had fallen as well. And indeed, on funds where we produce an estimate every quarter for where the funding level has got to, what we've actually seen is the funding position has improved by the end of quarter three compared with the end of March. You'll also have noticed that one of the worst performing asset classes in the portfolio was investment grade credit. And you may remember the real William telling you a few years back that the fund invested in investment grade credit because it was a good protection asset. So you know, why is an asset class that's supposed to protect the fund perform so badly? And the answer is because those protection assets protect the funding position. They're not there necessarily to protect asset values, although they sometimes can. What they're really there for is to protect the funding position. And they do that by tracking the liability values. So when rates go up and liability values fall, you'd expect investment grade credit values to fall as well. But similarly, when rates go down, you'd expect both liability values and investment grade credit to appreciate. So that asset class is protecting the funding position, not necessarily the asset value. I think that was all I was going to say, actually, by way of highlights in the quarter, but happy to take any questions.
Great, that's very helpful addition to the information we have. So questions on what Philip said, or general comments or questions on the paper that's in front of us? No? Well, what I'll do then, just to run through taking account of the difference between noting and approving, I'll take us first to 1.16, 1.17. We did receive those presentations, so we can't unagree those because we did it, so that they are history now. 1.11, approving the allocation to the fund private debt provider. Is that approved? Yep. Approve the draft response to the DLUC consultation on the task force on climate related financial disclosures. Agreed. And approve the pension fund newsletter to be circulated to fund members. Agreed. And agree to note all of the other recommendations. Agreed. Thank you. Is your microphone on, Legacy? Thank you. Thank you. I don't see any other business on that, so that item is now complete. Date of next meeting is not until the 21st of March. We're one of our longer breaks, but we are putting together an updating training session on the 5th of December, which you should have seen information about. So thank you very much for your involvement and patience this evening, and see you all again in March.